Okay, so look at this pro forma. This is the same one you've downloaded from our website, the Harvest Growth Pro Forma website sample. You can see the title up here at the top of the screen. I'm going to walk you through to make sure that you understand exactly how to use this spreadsheet. Look at this. It looks like a lot of numbers, I know, when you first look at it, but it's actually pretty simple and it self-populates. So if you've downloaded this and played around with it a little bit already, great, you've started to learn it. But let me explain to you the key things to pay attention to and the types of numbers that you're really looking for to make sure that your business is viable or that your product is viable as a TV business. Can your product sell on TV and in retail and still be profitable? Now, the first thing I want to mention is you can see my little icons down here at the bottom of the screen. You may not be able to see, as I don't in this view. I wanted to show you there's 3 different tabs. I can't see them though. So I want to show you, if you have the same issue on your website, there's certain computers do it, some don't. My small little laptop does it this way. So I wanted to show you, so in case you have the same problem. So you want to click, it might be a little bit different on yours if you're a PC or depending on what version of Excel you have, but you want to go to full screen. So click this. See how when I go to full screen view, now all of a sudden I can see the 3 tabs: the break-even model, the pro forma detailed, and down here at the bottom of the page, the retail assumptions. I'm going to walk you through each of these and help you to understand it. Now, I want you to pay attention to a couple things. One is, this is crucial. I'm so glad that you downloaded the pro forma from our website and are taking the time to look into this. I'm going to try to go through this pretty quickly, make sure you understand it very clearly, because to be honest with you, there are few things that are more important than the numbers as to the performance of your campaign. In other words, can your product be profitable on TV? You've got to make sure that you answer a few key questions in this pro forma or financial analysis before moving forward. Now, of course, I've got a little bit of a bent towards the finance side of the business. I started my career at Ernst & Young as a public accountant years ago, went through, now I wonder why, but 16 hours of testing for the CPA exam over 2 days, and did qualify, did certify as a public accountant. And then at my 2-year anniversary, left that, went to school at the University of Chicago, got my MBA, and transitioned into marketing. And I've loved it, of course, ever since. And sometimes I wonder, why did I sit for that test? Why did I go through 4 years of accounting studies and go that direction with my career? But to be honest with you, I'm so glad I did, because is what I do in this business, especially for our private clients that we work directly with, is help them to understand the numbers before getting started. Because sometimes if your margins aren't right, if there's some metrics that just don't make sense for your business, you better just not move forward. Go in a different direction or source a less expensive product, etc. Make sure before you even get started, before you invest real dollars in your business, that the numbers work. Now, you may have to invest a little bit just to get samples and get the right accurate costing, etc. But you want to make sure that you do what you need to do, of course, to make sure that these numbers actually work for your business. So let's walk through. So this first tab is the break-even model. This is where I would start with any business. Now, I've shaded in yellow the numbers that you can change, and then as you change them in here in this spreadsheet, then the result really that you want to look at is this pro forma detailed spreadsheet. So both the retail assumptions sheet as well as the break-even model feed in to this one, the pro forma detailed. But start here. Let me explain exactly what each of these pieces means so you can go in here, plug your own numbers in, and manage this. So as I mentioned before, we do a lot of this work for our private clients and help them to make sure that everything works before they even get started or go too far down the path, or to adjust the offer to make sure it makes sense. But I'm going to teach you so you understand you can do a lot of this work yourself. If you want to work directly with us, feel free to contact our office through our website, harvestgrowth.com. We can arrange an appointment and see if you're a fit, if it makes sense to work together. We certainly can help you. But I'm going to try to teach you enough here that at least you can get started and see if your business is viable and understand the basic metrics, especially if you truly are going to walk down the path of launching the product on your own onto TV or into online marketing or even into retail. And this document, feel free to take with you, use it for the first product, for the 10th, use it over and over again. I put this together obviously from my experience as a public accountant, but more directly from my experience while managing brands at Orange Glow International, which was the company, of course, that marketed OxyClean, Kaboom. I used to run the Kaboom business, ran many launches, as you know, for the OxyClean brand as well. So we got into these metrics a lot as we ran the businesses. So the format, the structure is a little bit different now, but the numbers are the same. I just kind of cleaned it up over the years since I left there. But you'll start to see some of the key metrics we looked at and how to analyze a business before even getting started, of course. And then, of course, some numbers to look at afterwards to make sure that your business is viable and successful going forward. So up here at the top, so I want to explain a couple things. See this green box over here? This is the revenue section. So this whole top section is the revenue section. Down below, these are all the costs. And then here's the margin profit you're left with. Now let's start here. What we're targeting, our goal is to have this margin. Now this is really the gross margin percentage. We want that to be around 60%. 59 is okay, 58, that kind of thing, but around 60% or higher. And the reason is if you take, and that's what this number down here, this 1.64 is calculating, is it's 1 divided by your margin. So as you can see, it's up this formula up here, 1 divided by F33, which is this number. And that gives you this 1.63. Let me zoom in a little bit to make sure you can see this sheet very well. That's the wrong direction to zoom. So 1.64. Break even, what that's telling me is for every dollar we invest in TV media or airtime or advertising, I need to generate $1.64 or $1.64 in revenue in order to break even. Everything above that is profit. So this is an important figure. So if my margin is too low, if I just plug a number in here, let's say at 50%, which seems like a pretty good margin, but at 50%, I need to generate $2 for every dollar I spend in advertising. And the lower my margin goes, the more difficult that gets to do. So let me undo that so these numbers actually work. Now, I wouldn't advise that you change any of the numbers that aren't shaded in yellow. I just did that, and I may do it some more times just to prove a point in terms of the way the numbers work. But if you plug in numbers in these yellow sections from your actual business, everything else will self-populate. All the calculations are done. You won't have to do any complicated spreadsheet work. You don't need to really even understand Excel. Just you can change the numbers once you understand what they are. So let's go back up top to the revenue area. This is the main offer area right here. So this row going across is I've got my main offer price. In this example, I'm selling a product for $14.99. That's the TV price, plus $7.99 shipping and handling. My conversion rate on a main offer is always going to be at least 100%. So anybody that orders, of course, they're going to buy the main offer, unless something's weird where they can transfer out and upgrade to a deluxe or whatever. But generally speaking, that'll be $100. It might even, or I'm sorry, 100%. It might even be more than that. For some of ours, we've averaged 2 or more with the units, where if we get a discount on the second one or whatever, they might buy multiples of them. But it's generally, again, at least 100%. So of the people that order, that's what this conversion column represents. Of the people that order, 100% of them are going to buy this main offer. 20% this, 20% this, etc. And I'll explain what each of those pieces are. But back to the main offer. So going across, we've got conversion, and then this is just a calculated number. So you don't need to do anything over here. But basically this $14.99 is your price times your conversion rate. And the shipping and handling revenue, same thing. Your shipping and handling times your conversion rate. So it'll make more sense as we change this from 100%. So the premium, what this is a premium this is the giveaway that is shown in the TV ad versus an upsell. These right below it, where are generally speaking, upsells are not shown in the TV ad. They are shown once you call in or once you go to the website. After you've placed your order, they say, hey, how would you like to buy another one? How would you like to get, in this example, continuity, which would be auto ship. If it's an acne cream, for example, join our auto ship program. We'll ship you a new bottle every month. You'll get the same discounted TV rate plus free shipping and handling. See how it's 0 there. Now, and this assumes on that example, I might get 20% of the people to say yes to this particular upsell of continuity. Now, this number is a little bit different than the others because I multiply it times whatever my average number of months that they'll stay in before they cancel. So 3 months is a pretty conservative average, depending on your product, if you even have auto ship or continuity. But for ingestibles, for creams, makeup, cleaning products, anything that's refillable, auto ship is a great way to go because you've got them in the system. You can maybe give them free shipping or a 20% discount, but anything to keep shipping to them, your average order value or per customer is going to go up. So these upsells, like I said, are not mentioned in the TV spot. The premium is. So let's say if this is OxyClean, that is the main offer. You might buy a 32-ounce bottle of spray laundry additive, OxyClean, and the premium would be get a second bottle for free, just pay additional shipping and handling. So free, meaning no additional price revenue or offer revenue, but an additional $7.99 that the consumer might pay for the second bottle. So for example, just to understand that math, if I in this particular offer, a buy one get one free, but on the freebie you generally pay separate shipping and handling. So let's just use easy math, $15 plus $8 shipping and handling, plus an additional $8 in shipping and handling for this second one for the premium. If they order everything, a $14.99 offer, or $15, let's call it, is now $15 plus $16 in shipping and handling. So that's the way that these big, huge, inflated offers can be profitable on TV. So plug these numbers in. Not everything has to have a premium. It might be a deluxe version. It might be an upsize. You may or may not charge additional shipping and handling. I wanted to put this in here so you at least understand the math if you choose to do it that way. And watch, at the end of the day, watch infomercials. Watch some DRTV spots. Of those that you like, go out and buy a couple on the phone and over the web just to watch and see how they do their offer process. A lot of this will make more sense if you haven't bought them in the past or it's been a while. So you can see exactly what I mean in a real life setting. Now again, back to this premium, I'm assuming on this one 80% uptake on the freebie. You can do what's called a forced premium, which means a forced upsell, which this second bottle free plus additional shipping and handling, you may not give them the offer to say no. They either get both or they get nothing. In that case, the conversion would be 100%. This one is assuming an optional. And even with the optionals, generally these have pretty high uptake rates. So 80% is a good number to use for this conversion of a premium. And then, of course, the math goes across. Product revenue, there's none, of course. And then the shipping and handling price is $7.99 times 80% gives you that $6.39, right? So again, all you have to worry about is this section here, things that are shaded in yellow. So if you want to change your offer price, change your shipping and handling price, etc., for any of the main offer or the upsells, and even if you change down here, let's change this word continuity to test. Watch how that changes below. So it'll even match down below. Again, I'm going to undo that. So just if you change the words up here to match your product name, that's fine. It'll flow down here just to keep it clean and easy for you. So hopefully that makes things easier for you. So continuity we talked about. Upsell number 2, for example, this might be downsell, one additional bottle of OxyClean, let's say. So if they say no to the continuity, no to the auto ship, then a downsell, what that means is upsells are offered to everybody. A downsell is only if they say no to something, then you give them a backup offer. So they said no to the auto ship. Well, hey, how about if we just ship you one additional bottle for $10 with free shipping and handling? So this is $5 off, a 30% discount basically from your main offer plus free shipping and handling. So you're saving $8. You're really saving $13 because up here it's $15 plus $8. And down here it's $10 for the same bottle, some kind of discount. Again, it depends on your cost structure, what you can make work, of course, but this is just to understand the lingo behind this and things to think about. Downsells work great for continuity or for deluxe versions. If they say no to the deluxe because it's more expensive, you might give them, maybe change the shipping and handling price or something so it's lower even though the cost of the unit is higher. Let's say a deluxe version of this or an upsize version that's twice the size might be an additional $5. You might downsell and say, hey, how about an additional $2 for it? Whatever. So it gives you that option to think about. Of course, times your conversion rate, and these roll across automatically. Now you'll notice that I use 20% for the conversion rate for the upsells. I would keep those at least as you get started, unless you've got some intel that I don't have specific to your product. 20% is a good target. For any upsell we're looking at, we want to generally get at least 20%, and that should be easy to get. Now, if you're not seeing it, if you get a 5% conversion, on one of your upsells, then you probably want to get a different upsell. So that's you play around with this until you get to these numbers. But 20% is a good figure to look at. It's pretty standard in the industry. If it's higher, fantastic. But I usually start these calculations pretty conservatively. So then the upsell number 3 in this example will be some kind of accessory. What it might be chamois towels for a cleaning product, whatever, something that's related. These are generally sourced from from Chinese factories, from Alibaba.com. If you haven't been there, Alibaba.com. You can find and buy products directly from the manufacturers. And they would be, these are existing products. For upsells, you don't want to sell things that people have never heard of. Because then there's not enough space or time to be able to convince them, hey, what about this new product that is completely different? Try, he has these features and benefits. They'll click on to the next thing. The TV ad, your main product, absolutely should be unique, because that's the whole focus of the TV ad, is to explain why they should buy that product. But for all these upsells, think about products that people are familiar with. At least know what they are, and that you can provide a good value for. And if you buy directly from the manufacturer in China, you don't need to buy big quantities of these, and you can still get a good rate typically and make good margin on it. Another thing to think about is if you're trying to get upsells and you're in the early testing phase, you don't know what's going to work and what's not. Don't feel like you have to buy 5,000 units if that's the minimum order quantity from one of these Chinese factories. You can get away with doing what we call a dry test. So you could offer these for sale, these upsells, and if you don't have them in inventory, then you don't ship anything out, and you also don't charge the consumer for those, right? You put those on back order until you have inventory, until you figure things out. And if the conversion rate is really low, then you just go ahead and cancel that piece. Of course, you never charge people if you're not going to ship it. You don't charge that piece of it, but it gives you the data to figure out if you should have that as an upsell. Finally, down here, we've got rush shipping, or generally now referred to as rush processing. So this means, with TV products, the revenues or the sales figures can be so spiky. They can go up and down if you're on air, if you're growing your spend, if you're off air for a couple of weeks while you're waiting for inventory to come back in, etc. They go up and down. It's kind of hard in the early days to control inventory. You often go out of stock while you're waiting for goods to come over that might be delayed from China, things like that. So rush processing, what that does is people pay an additional fee, and it might be $9.99 for smaller, less expensive products. It might be $6.99 or $6.95 for this, but you're not shipping it necessarily faster, so it's not moving from priority to overnight, for example, or from ground to second day. Instead, what it does is it puts these people at the front of the line. So if you run out of inventory, you guarantee that theirs is the first batch that ships, right? So let's say I have 1,000 units in inventory and I get 1,100 orders. Well, 100 of those are going to go on back order. But all the people that paid for rush processing, used to be called rush shipping. You can kind of refer to it either way. I'm kind of old school, so I keep it as that, even though it's really processing. For all those people, theirs definitely ship out, right? So they're not going to get back ordered because they paid that extra fee. So that's a great one. Oftentimes you'll get 20% uptake on that, and it's primarily profit. It's a good figure to have. And then these columns now total up. Again, you don't have to do anything on here. It calculates for you. This 2758 represents the sum of all your product revenue, everything coming across, times these conversion rates, times the number of months, continuity, etc. Same thing for the shipping and handling, sums those up. And then this is your average sale price or average order value or your revenue per order. So see how we went from a $14.99 product down to almost $45 in revenue per order. So, and this is pretty typical. For a $14.99 or $19.99 product, you're typically going to be $40 to $50 in average order value when you add in all these upsells. And if this comes in low, then again, go back and work on your upsells. Try to get higher conversion rates or higher price points. Make sure that you got this figure. So you want to be around $40. Might be 35, might work. Depends on a lot of factors. But you want to get that to be pretty high. You definitely don't want to have a product that is just your $14.99 plus your shipping and handling. Maybe in the beginning, if you just at least understand that, hey, when I do upsells down the road, I'll be able to grow this, but you don't want to deal with it in the beginning. We have some clients that deal with it that way. That's okay. But just realize that long term, you're going to need to plan to have upsells, all these others in the mix to get this average order value higher. All right, so let's move on to the cost section. So the call center costs. These are some examples. So if you do IVR, which is versus live operators. So IVR is interactive voice recognition. So it's recorded scripts basically. Those are generally around 17 cents a minute. Could be more, could be less, but just an average figure. You multiply that times the average call length, this ACL. In this example, it's 15 minutes, which seems pretty long, but I've got, if you think about it, 1, 2, 3, 4 upsells that they're walking through this script. They've got to collect credit cards, shipping information, etc. And that's pretty conservative. You should be able to get a little less than 15 minutes. But again, in these analyses, I like to keep them conservative. You'd rather surprise yourself with lower costs than come back and have all these that are higher than you expected. So be conservative. And then on live sometimes, but always on IVR, you're going to have a transcription charge. So generally 33 cents an order is kind of a normal figure, where that means to transcribe the spoken content. So some things like their address or their email address, they can't really key into the phone, or it doesn't recognize it. So it'll record, and then somebody probably overseas, depending on the company, writes that down. They transcribe it and attach it to the order. That's just another cost to think about that goes in there. So this $2.02 is an average price per order based on 17 cents a minute times 15 minutes plus 33 cents, and you take that whole number and multiply it in this example times 70%, meaning 70% of my orders are going to come over the phones. Now, the older your demographic, the higher the phone number cost will be. Generally speaking, now you're pretty safe to use a 50% figure. Again, I like to be really conservative on these. If I change that to 50, you'll note that the gross margin went from 60.9 to 62.2, so it gets better as your costs go down, just because you're minimizing your costs associated with your call center. Fulfillment costs. This is your warehouse to pack and ship, unless you've got a really big bulky item. This is not including shipping and handling or the freight cost, but labor, materials, customer service, processing the order. About $250 is the number I'd use in there on a per order basis. If you're much more than that, then you're probably not with the right fulfillment house. Unless, again, it's a big, bulky item or it's something weird or different about it. Shipping. Now, this is the freight cost. So this is the actual shipping. Again, this can go up based on the size of your product. You can kind of check this based on the weight and size on the USPS website or UPS site to get the cheapest rates. Realize that you could definitely save, well, I should say probably, generally speaking, you can save 20% or so versus that, or more sometimes if you work with a big fulfillment house, because they get discounted rates. They ship so much out from their warehouses that they get discounted rates. So anyways, assume $3. Yours might be different. Again, you can, because it's shaded in yellow, you can change that. If it's $4, you can see everything changes. The margin then populates down here. Now we're at a 60% margin. Well, let's say 3 to start. Now this is your cost of goods that you're going to plug in here. So for your $14.99 item, I've said this before, you want your sales price, so the $14.99 in this example, to be 4 to 5 times at least your cost of goods. So in this case, I have a $3 cost of goods. This is your landed cost, what it costs you to manufacture each individual unit that's sold on TV. If it's $3, I multiply that times 5, that gets me $15. So it's a good multiple. We've got a good margin there. If my price is much more than $3, if it gets up to $4 or $5, then I probably have to price it at $19.99 or higher, depending on the product we have. Now, obviously, you can take this math, and if you've got a half-hour infomercial and you're selling something for $200, the same principles apply. You just adjust your cost of goods. You want to make sure all the principles apply, no matter what the cost is, or the price point rather, is for your consumer. So these conversion rates over here, these automatically fill in from the ones up top, so don't worry about changing them. Again, just change the numbers that are shaded in yellow. That's all you need to worry about. Everything else self-populates. So let's say your cost of your main offer is $3 right there. In this regard, my premium is a buy one, get one free. So it's, as you can see with this formula, it's the same. But if you do something else as a giveaway, if it's a free flashlight or whatever, just make sure your cost of goods populates in there. Same thing for your continuity is going to match that automatically. But if it's something different, you change these upsells, just make sure your cost is correct for it. The additional bottle, all these are the same cost. Accessory, if I'm selling it for $10, might cost me $1 or $2. Rush shipping or processing, I put 50 cents in. To be honest, it's probably zero. There's not really much cost associated with it. Every now and then, fulfillment houses charge a fee, so I have that in there to be conservative sometimes, but it doesn't make a big difference. All right, and then credit card processing. This is the fees that are paid to Visa, MasterCard, American Express, etc. On average, they're a little less than 3%, so I just use that figure, again, based on your order value. Returns, the more expensive your item is, the higher the returns. If you have a DVD set that costs $150, you might see return rates of 10% or even 20% and still be profitable sometimes. For a $15 item, generally at around 2%. People aren't going to ship this stuff back. It's just not worth it, right? Because they usually with returns, your guarantee covers the $14.99, but not the shipping and handling, and they got to pay to ship it back. They just say, forget it. So generally they're pretty low. So I use 2% for that. You're safe. Unless you've got a really expensive item, then you want to make sure you increase that rate. All right, so this total cost figure adds all of this up. It does all the math for you. In this example, remember I had a $44 average revenue, and my cost for that $44 is $16.75, which gives me $27.81 in gross profit before I pay advertising, all that kind of stuff. Again, my margin rate is 62% in this example. Again, want to keep that 60% or higher, or at least close to 60%. If you're 59, you're probably okay. And again, this break-even figure tells you what you need to be at in order to be successful. All right, let's move on to the retail assumptions. I'll go through this pretty quickly. Again, I've got shaded in the numbers, most of them that you'll fix. All of this stuff up here kind of self-populates. I'm making the assumption this one starts in month 6 because it's generally going to take you at least 6 months after you're successful on TV until you start to get some revenue from retailers coming in. It just takes time. You got to meet with them, make sure you meet their shelf reset timing, etc. And this one, you can tweak and change some of the numbers around a little bit. I don't shade many of these in just because most people, if they don't have retail experience, they don't know what to change the numbers. So these are pretty conservative, relatively standard numbers for a successful TV product. If you understand Excel, want to make some changes to it, feel free, but it's just kind of a good average analysis to look at. But let's look at this bottom section, the assumptions. So I've got 2 general types of stores, mass up here, and then specialty stores. And the reason I change these is your margins are generally different at mass, which might be like a Walmart or Target. So this one I put a pretty low margin in there. Often this could be, their margin might be 50% as opposed to 30. Just depends on the category. So you can change that. If it's 50%, you can see how the numbers all roll up together. In specialty stores like Bed Bath & Beyond, the margins are often higher. So the retailer might have a 60% margin, which that changes their wholesale price that they'll pay you for. So, and all those things populate automatically. So your retail price that's taken from that previous spreadsheet, it matches exactly because whatever you sell it for on TV, it's the same it's going to sell for in retail. You can adjust this on your own, but again, I wouldn't, because typically that's the assumption. The wholesale price calculates automatically, and then again, your product cost. The reason I make this different is right now it feeds from this previous break-even model, and the reason I do that is I want to make sure that you have some flexibility, because sometimes your cost of goods might be $3 over in their TV item because you don't have packaging that goes with it. It's different packaging, and then you've got this really fancy retail packaging that might take your price, let's say, to $3.50, right? So you want to make sure these tie, as they do right now, they tie to each other, right? So I change the top and it changes the bottom. You might have different packaging for each one, etc. And that gives you a product margin, 53% up here in mass, 42% in specialty, and then you've got your assumption of a broker's fee as well. This is typically anywhere from 5% to 10%. The smaller the number of stores that you have your retail brokers going to, the higher the commission they're going to earn. If they're selling into Walmart, Target, the big guys, then you shouldn't pay more than a 5% commission. If they're selling to Bed Bath & Beyond, maybe, and some smaller ones, it could be 8 to 10%. So you can adjust that rate if you want to. But everything else self-populates, and I'm not going to go through it all in detail here. You can kind of just see the numbers. We're going to go back now to this is what I would say is the important result sheet, the one we're going to want to look at to see how the results of all the stuff that we've plugged in now, so what happens to the business. Now let me explain a couple things really quick, and we're almost done with this. Hopefully this is making sense and helping you out. As you go across the top here, this is again your first 13 weeks of your TV launch, and then it goes into monthly after that point. So your first quarter, or 13 weeks, is done weekly. Everything else after that is monthly. So that's why these are shaded in green. Note that I've got this first week we're on the air, and then I've got 2 weeks right here, which is what we call a media hiatus. I'm going to grow this spreadsheet as well so you can see it when we go to see what 150% does. So we've got, and if you have to zoom into this to see it better on your monitor, of course, feel free. But these numbers hopefully should make some sense as you start to see them now. The reason you go off the air for a couple weeks is, let's say I spend $10,000 in media, I get $20,000 back in revenue. What happens is this week that you're on the air, you actually don't get your results back from the TV stations until the end of this week, the end of week 2. We know the revenue as it comes in because you see the credit card sales coming in real time, but what we don't know is exactly what stations we aired on, what times of day, how much exactly we spent, and you get those results about a week later. So when you get those at the end of this week, you decide, okay, let's go back on the same stations, let's grow it, let's change it, and then you have to pay the stations a week before you go on the air. So that's why you're off air a second week as well, generally speaking. And if everything is going well, then you'll be on the air continually for these next several weeks. Now you may have a few more of these hiatuses if you're tweaking, changing, trying to work on it and improve it, but this kind of assumes basically this analysis starts after you get to the point where you are successful, where you're making money on TV. So that may take a few weeks of testing depending on your product. But let me show you how this one works. Again, you can change a few figures that are highlighted in yellow. These are the key ones, and then everything else kind of self-populates. So one of the things you might change is your media spend. Let's say I want to spend $15,000. We have one client that does that. They want to spend more that first week. Everything else changes automatically. But let's take that back to 10,000 because that's kind of the standard. You can do less too, but the standard is about $10,000 spend. So this one calculates my media spend of $10,000 times this MER of 2.0. So I'm assuming a successful, kind of standard successful campaign of a 2.0. If I have, we have one client right now that's doing a 3.0 or higher. You can see how, let's watch how these numbers change down here in this net margin area. So let's say, for example, even this week we've got almost $13,000, 12,913. If I change that to a 3.0, my MER, watch how that changes. It's amazing how the more successful your results are, your return on investment are, the more profit you're going to get. And you see how this thing scales like crazy once you have one of those really high MERs like our client luckily has right now. They're doing really well. But kind of a standard success is that 2.0. That's what I would plug in for your analysis if you're raising money or if you're just trying to make sure your business makes sense. And anything above that is gravy. If you get some actual numbers that are 2.2, great. Plug them in. You'll start to understand how the business runs itself. But again, to start, keep it at a 2.0. I'd recommend. The other assumptions that you can change. So some of these other assumptions like the average order value, cost, or break-even ratio, I just bring those over from that first sheet we looked at. So they tie together. If you change it on the other sheet, they tie over here. Just so you have it here for reference, so you can kind of plan, understand the numbers. You can always go back to the other spreadsheet, but you don't change these. These populate automatically. This $1 million figure is assuming basically a monthly spend. You set your max. So we've got it at $1 million right now. You can kind of see where we get to the point, and this thing calculates automatically in month 4. We're at $1 million a month, and it caps out. So my business is no longer growing there. You've got to pick a number. This is the thing that can change drastically. So for the most successful campaigns, the crazy successes, this might be, let's say $5 million a month. Did I do that right? Number of commas or zeros. So at $5 million a month, you may not hit that in month 4, right? But it's going to keep growing up until it hits 5 million, and then it stops. And the reason you got to plug a number in there, again, I would use $1 million to get started, because it's kind of a conservative, relatively normal number to look at for a successful campaign. $250,000 a week is very successful, but you might be higher, might be less, but it's kind of a normal success where you saturate, where you might not be able to grow beyond that point. So use that to start, but you can change it if you just want to see how it changes the numbers. The other piece here too is if you have some additional money on the side where if you're successful this first week, you're getting all your metrics, you want to invest more money into it. I put $50,000 here to start. I would actually start at no more than probably $5,000. It helps you grow. The more money you put here as an additional investment beyond the profits that are coming in from the advertising itself, it just means the faster you're going to grow your business. And you can, if you want to make additional investments weeks out here, feel free to do that. I try to keep this relatively simple. So I just put this one single investment. Obviously, you can make this as complex as you want to take it, but this is a pretty straightforward approach and kind of standard approach. One more thing I want to note is something to caution you. If you change around your metrics in a crazy way and you do something where you hit $1 million in spend per week as opposed to per month, so let's say you hit it in week 12 here, then it kind of messes up the math, because it's really meant to be, this max spend is meant to be a monthly spend. So just kind of look over and make sure you're not hitting that too early, right? Because once you start in this month 4, it's 4 times what happens in week 3. You should be okay depending on how high this max spend is. If I set it at, let's say, $20,000, is the most I can spend per month. Well, look, I hit that pretty quick, right? And then it kind of messes the math up a little bit. Your monthly doesn't change, just because, again, I've got it maxed out. That's not the way the formula is meant to work. Again, I try to keep this pretty simple for most people. So just watch out for that piece of it too. If you're not hitting it in your weekly, then you're probably okay. It shouldn't really change too much. But if so, contact our office if you're having real problems with this, whatever. Again, we do private client consulting on these things, of course, but I'm just trying to give you a good understanding. So let me quickly explain how all this works with all these assumptions we just talked about. I plugged my $10,000 in. That means I get $20,000 back in revenue based on my 2.0 MER here. And then these main offer costs, the upsells, fulfillment, postage, all those come from that first break-even model spreadsheet. All this self-populates. And you remember we had a 60% gross margin on that spreadsheet, so that carries over here, less my media. My net margin now is at 10% once you take the media out, right? So that means cash in the pocket basically is about $2,000 off of this, right? Which doesn't seem like a ton, right? You make all this money and you've got a 10% profit margin. But the beauty of this is this includes your advertising, includes all of your costs. That's true cash in the pocket. And you've got a scalable business now that you can grow very quickly as long as you maintain that profit margin. So, in week 1, it might be $2,000 in profit, even off of $20,000 in revenue, right? But as you get out here, let's say at a month 12, right, a year out, now all of a sudden that's $600,000, your margin per month now in the pocket, and that grows pretty tremendously, especially as you start to see retail revenues come into play as well. So feel free to play around with those assumptions, etc. And then basically you can see now. So then now the spreadsheet's done. This is to the point where you can share with an investor. You can, again, if you need to make these things a little bit more specific to your product, add some costs in, and you know how to work spreadsheets, great. But this is simple enough that you literally could just copy and paste this. We've had people that have taken these spreadsheets and they've gone out and they've raised millions of dollars in funding for their businesses without changing much, right? Sometimes they'll hire us on to do some complex analyses and that kind of stuff, but this should be enough to at least get you started. One thing I forgot to mention over here on the retail assumptions sheet, I want to make sure I say before I end this training, is this a couple things. One is the number of stores in each category. I've got that for mass, I've got it for specialty. So again, I wouldn't change it necessarily, but you should be starting off, maybe around 1,000 stores with, if you get into Walmart, Target, and a couple others. Do a relatively small store test, a few hundred each. That's where these numbers come from. But again, you can change these. If you want to plug it in at 50 stores, just make sure you carry the numbers across. The units per store per week, or this USW, is the number of units that sell in each of those stores on a weekly basis. So just so you understand what those numbers mean. I use 5 as an example here. You can, if you have more than that, especially as you start to see some real numbers coming in. Let's say you're a year into this business, you can and should keep updating all of these spreadsheets. Once you know your retail performance on this sheet, once you know your true cost, and your fulfillment might come in at 240 rather than 250, and all these different metrics. Your actual MER rate might not be 2.0, maybe it's a 2.2, like I said before. So keep plugging these things in as you get actual numbers. Compare them against your assumptions that you have going into the business, and you'll be able to track going forward. But I highly recommend, this is a very important part of the process. It's not always fun for everybody, which is why I tried to put this together in such a way that's pretty user friendly, where again, just change the items in the yellow highlights, everything else takes care of it itself. And it even rolls out for a 2-year period of time. So in this example, you can see this month 24. Just for this month, we see a couple $1 million in direct response revenue, a couple million in retail. My margin's a little bit lower just because of the changes I made on the retail side, but I've got $1.3 million in net margin from that month coming in, which is a 30% margin. You can see how the retail side ultimately helps your margins to go up after you get just the TV piece, just because TV is such a big component. If you think about it again, you're getting free advertising, so that when you're making a little bit of money up front, this 10 or 15% margin on your advertising, just realize that means you're making money as you raise your awareness of your business. So have fun playing around with the spreadsheet. I hope this makes sense. I hope it was helpful to you. Definitely make sure you do some of this analysis. Look at these numbers. Make sure the numbers are viable for your particular business. We wish you the best of luck, of course, with your product launch. Feel free to call our office if you need any private client assistance. We're glad to work. We do this with dozens of clients a year, of course, where we can help you do the launch, or feel free to use this on your own and run it along with the other resources that we sell, and some that we give away for free, of course, to help you in the way as you launch your business on TV. Well, best of luck with everything, and we look forward to talking to you again soon via email, or if you call our office, we'd love to chat with you, and hopefully someday meet in person and hear about the successes that you're having out there. We love to hear when people are putting these figures and these plans into play to see successful launches on TV. So please keep us posted as you have those successes. We love to hear about these wins, and wish you the best of luck.